Hi guys, welcome back. In this video, we're going to be covering the circular flow of income in an open economy, where we bring other players into account, other players that are taking part in the economic activity and the generation of national output and GDP. That is, we'll bring in the government and the international sector. Now, the thing is that when we talk about the open economy, we specifically refer to the international sector that includes your exports and imports. But, the government as a player could be included in the closed economy as well. But since I did not do that in the previous video, so I'm just including it in the open economy, right? So an open economy is basically taking into account all the players, right, including the government. But primarily when we say that we're talking about open economy, we are assuming that now it means that this economy is open to international trade, and hence there would be exports and imports taking place. Anyway, so up till now, our assumption was, guys, that all the spending that was done by the households was on the domestic goods that were produced by the firms. But now we will learn that the demand for domestic firms' output, not just arises from consumers' expenditures, but from other sources as well, such as the government spending on domestic output. The government expenditure that we say, which also refers to as the government consumption of domestic goods and services. And also, that expenditure comes from foreign residents who are abroad buying our domestic goods. And similarly, the thing is that not all that is, households do not end up spending everything on buying from domestic firms. Some of the incomes generated within the circular flow may be spent on purchasing imports as well, right? As I mentioned, the final spending on goods and services is not just comprising of individual consumption spending on, so what we're saying is that the final spending that is taking place, that is, you see over here, this total, the final spending that is taking place is not just the consumption spending by the domestic households, right? Where, they are paying for the goods and services. So it's not just the consumption spending that is included as part of total final spending. We see that in a realistic economy, which also indulges in international trade, your spending would also, include your government spending and export expenditures and investment spending as well. So what we're saying is that, since our GDP, that is our national output, since our GDP, that is the total output produced, that the value of the total output produced, is equal to your national spending. So if we want to find out our total national spending, we need to add up the investment spending and the government spending and the export expenditures that are taking place in the economy, right? And so what we're saying is that the sum of all these, the sum of the household consumption, that is consumption expenditure, investment spending, the government spending, and the export expenditures, will be part of the final total spending in the economy, which will be equal to the national product, right? So the economy's national product is equal to the sum of these total final spending components in the economy, right? And so what we're saying is that, as I said, when we say that it is still true that the national product or your GDP is equal to the sum of these total final spending components, it is also true that this total final spending that comprises of the expenditures from households, government, investment expenditure, and exports, this total final spending basically creates total incomes that can be added up to, it creates factor incomes that can be added up to generate the equivalence, right? Between national income and national output. That is, national income equals to national output, basically. So total final spending is taking place on the national output, right? Which means that the value of total national spending must equal to the value of national total output, which should be equal to your total national income, right? Because the final spending is creating incomes that are added up to generate equivalence between national income and national output. So the flows on the left hand side of the diagram that you can see have to be equal to the flows on the right hand side of the diagram, because any flow that generates spending also generates income, right? And I already introduced you guys in the previous part 1 of the video about what injections and withdrawals or leakages are. Withdrawals could also be termed as leakages, are right, from the circular flow, injections into the circular flow and leakages from the circular flow in part one of the video. And so from here onwards, when we refer to as injections, whenever we hear the word injections, we will be referring to as investment spending, government spending, and export. So injections, guys, as I mentioned, which was also mentioned in the previous video as well, this word injections basically is referring to, your injections are basically referring to your investment spending. And I'll write this down as well. Your injections are basically referring to as investment spending, right? And your government spending, and we are also including our exports. So these are our injections into the circular flow. While when we talk about our leakages from the circular flow, we are referring to as savings, we are referring to taxes, and we are referring to our imports, right? Which are basically your leakages are basically our withdrawals, right? And so, guys, when we say that for us to say that the level of our national income and national output is constant, and it's not, or you can say stable, the injections of the spending from that are taking place from outside the circular flow, right? The injections that we are referring to as investment spending, government spending, and exports, because they are all taking place from outside the circular flow, because they are referring to spending other than households. That is why. And I mentioned this in the previous video as well. So the injections of spending from the outside of the circular flow, they must equal the withdrawals or leakages that are taking place from the circular flow, right? So these injections are referring to spending from outside the circular flow, and the level of injections must equal the level of leakages for the national income and our national output to be constant and in equilibrium, right? That is stable. Otherwise, if they're not equal, then national income or national output would be rising or falling depending upon if the injections are greater than leakages or the leakages are greater than injections. Ultimately, yes, a new equilibrium will be created and ultimately they will be equal, and we'll see that process as well. Right, but what we're saying is that for the level of income and output to be constant and stable, or for the equilibrium to be achieved, your total injections must equal your total leakages, right? Now, guys, as far as your injections are concerned, we've already seen investment expenditure in part one of the video, but I'll just talk about government spending and exports as part of injection. So, like I said, not all the spending that is done on the domestic firms' output is done by households. Some of the spending is done by the government as well. And when we talk about government expenditure, we are saying that we are referring to that when the government spends money on goods and services that are produced by firms, and so this counts as an injection into the circular flow. For example, such expenditure could include spending on roads, hospitals and schools. Or maybe, so when you're saying government expenditure, what we're saying is government spending. Government spending is, another word for government spending is government consumption spending, which means government consumption spending on the goods and services, right? However, so for example, let's say when the government is, government buys a paper clip, or it purchases fuel for, its army or navy, or maybe the government buys furniture, or it builds a road, or spends on hospitals. So what we're saying is that because when the government does all of this, it is directly adding to the demand for the economy's current output of goods and services, right, guys? So this form, what? However, do remember that when we're talking about government spending, we are excluding transfer payments, right? That is, we're excluding state benefits and transfer payments or unemployment benefits, right? Which is transfer payments as well. So we are excluding that. That does not form part of government's expenditure, right? So that does not form part of injections. Secondly, what you need to know is that the government spending, that is the government spending on the current output, on current production, this will form part of your total spending. So the spending will come from the households in the form of payments for goods and services. Then you have investment spending by the firms, and then you have government spending by the firms. So it will automatically form part of total spending in the economy, right? So you have this flow, going. That is, it includes total spending. Some of the spending is done by households, while other is an injection into the circular flow that forms part of spending. And then you also have exports, right? So you have export expenditure, which is basically money flowing into the circular flow from abroad. When your residents abroad buy our domestic goods and services, they buy our exports. So you have, so the abroad, the residents abroad, which could include the firms as well, or foreign governments or individuals, they basically buy from us. So that is basically exports. So that is export spending. So export spending again will form part of total spending. That is why all these arrows are connected over here, right? That is why I've connected all these arrows over here, because that is forming part of total spending in the economy, right? And the total spending is basically on our domestic output, right? And since the spending is on domestic output, so the value of the output that is produced in the domestic economy, which is your national output of GDP, will form part of will again then generate incomes in the economy, right? Factor incomes in the economy, that is national. So again, that should be equal to national income. So your national income, guys, should be equal to your national output. And if your national incomes are equal to your national output, right? So the amount of national income is equal to national output. That is when when you have a macroeconomic equilibrium, right? So basically your injections is the sum of investment spending, government spending, and your exports. So guys, now then it follows that for income to be unchanged, right, your injections of your extra spending into the flow must equal the leakages from the flow. So what you're saying is that for your national income to remain constant or be in equilibrium, basically, because equilibrium means that they both are equal. In other words, there's no tendency to change anymore. So for income to be unchanged now, your total injections, your planned injections must equal your planned leakages or planned withdrawals, right? And so what we're trying to say is that, but the thing is, guys, you see, we have indirect links between saving and investment, taxation and spending, government spending, and exports and imports and exports. We have these links established through financial institutions, the government, and the foreign countries respectively, right? So obviously, I mean, if more money is saved out there in the economy, so there's more leakage in the circular flow, but then more money will be available for banks to and other financial institutions to lend out. So more investment will take place. So S will be equal to I. So again, withdrawal equals injections. And if there are more tax receipts, right, more money flows out as taxes, so there's more tax receipts to the government. So there's more withdrawals, but then that money, the government will be, more keen to increase its government spending. So again, T should be equal to G, which means again withdrawal equals withdrawal equals injections. And finally, if your imports increase, let's say M increases, what will happen is if you're importing more, right? So there's a leakage from the circular flow that is taking place. But then this imports that you do means income for people who are abroad, income for foreign countries. And if you import from them, their incomes will rise. And if their incomes will rise, that will enable them to purchase our exports. So if M goes up, automatically X, your export should go up. If T goes up, automatically G should go up. If S goes up, automatically I should go up. And so it follows that ultimately your economy will reach equilibrium because, and when it does, we say that, your economy, your planned injections equal your withdrawals, your injections equal your withdrawals, your economy is in equilibrium. Now, there's no more tendency for national income to change, right? But the thing is that, we just like the links I established right now, I said, Kate, there are indirect links between your saving and investment and taxation and spending, government spending and imports and exports. And these links are established through financial institutions like banks, the government, and your foreign countries. Just like I said, if you import more, then that creates income for foreign countries and they will import more from us, so our exports will rise. And if more is collected in taxes, there are more tax receipts, so ultimately the government will spend back, right? And if more is saved, then financial institutions will have more money to lend out to firms, right? So investment will go up. But the thing is that these links that I have established, they do not guarantee that S will always equal to I. It could be a big possibility that your saving is not equal to your investment. It could be a possibility that government spending is not equal to taxation. Maybe the government spending is more than taxation, or the tax revenue is more than government spending. Or it could be a possibility that firms they wish to invest more, or they would wish to invest less than what people wish to save, right? Or maybe the exports could possibly exceed, imports, so they won't be equal. And the thing is that the reason is that, why would S not be equal to I? Because the decision to save and the decision to invest is made by different people, and hence they plan out and save and invest different amounts. Similarly, the demand for imports may not always equal the demand for exports. And as far as your government is concerned, your state is concerned, maybe it may choose not to make T equals G. Let's say it chooses to run a budget surplus where T is more than G, tax revenue is more than spending, or maybe a budget deficit where it chooses that government spending will exceed taxation, right? It may choose to spend more than it receives in taxes, that is to run a budget deficit. Either it will finance that either by borrowing or printing money to make up the difference, but whatever the case is, it may not always be equal. Hence, what it follows is that our planned injections, which we're calling it J is referring to our injections. This may not always equal to our withdrawals or leakages, right? And so guys, let's say that your injections do not equal your withdrawals, right? And so for example, if your, injections are more than your withdrawals, so in this case, what will happen? Obviously the level of, because if injections are more than withdrawals, injections form part of the total spending in the circular flow, right? Remember we talked that this is going to form the investment spending, the government spending, and the export spending will form part of your total spending. So what will happen is that, your total expenditures, the total spending in the economy, the level of expenditure in the economy will rise. And what this will do is that this will result in a rise in aggregate demand, because aggregate demand is your total spending or total expenditure in the economy. So this extra spending that takes place in the economy will, boost firms' output and sales, and it will then force and motivate them and encourage them to produce more output. So total output in the economy will rise. And hence, when total output will rise in the economy and firms are producing more, so obviously thus firms will then pay out more in wages and salaries, and because obviously they're going to hire more factors of production from households, and so they will end up paying more in wages, salaries, profits, rent and interest. And as in other words, what will happen is that on one hand we see national output rising, and then obviously national income will rise as well. And so what we need to do is that we need to know what impact this will have on macroeconomic objectives, because usually when the question on circular flow comes in an open economy, they usually ask the impact of increasing injections on the macroeconomy. And so you need to talk about 3-4 macroeconomic indicators that a rise in injections will have. So obviously, first of all, it is going to cause economic growth in the economy, right? Because when your injections are more than withdrawals, right, it is definitely going to cause economic growth and your GDP would increase, right? And so, and the greater do remember this thing, that the greater the initial excess of injections over withdrawals, right? So that, let's say that the greater the more the more injections take place in the economy outside of the circular flow, right? Autonomous injections take place outside of the circular flow, the greater would be the rise in national income, right? So that's one thing. And the second thing is that it will also have an impact on unemployment, because obviously demand deficit, cyclical unemployment will go down. Unemployment will fall as firms will take on more workers to meet that extra demand for output. So cyclical unemployment goes down as well. And it will also have an impact on inflation as well, because inflation would tend to rise. There would be more demand for inflation in the economy, because the greater the rise in aggregate demand relative to the capacity of the firms to produce, the more the firms will find it difficult to meet that extra demand, and the more likely that they end up raising the prices. So this is what demand pull inflation is, right? That's why it happens. It will also have a negative impact on your balance of trade position. That is a negative impact on your current account position on the balance of trade, balance of trade position on the current account, it will become unfavorable. Because the thing is that, so it will have a deteriorating impact on your balance of trade, because when your national income goes up, that will automatically cause a higher demand for imports. So there would be more imports being sucked into the economy. We usually call this, economists usually refer to this as the sucking in of imports, right? And so on one hand, your imports are increasing, and on the other hand, since because of inflation, your domestic, because of inflation is making your exports less competitive, right? So, and this will cause a reduction in the demand for exports, while the demand for imports will go up, because imports will become relatively cheaper compared to domestic produced goods because of inflation. And hence imports are going to rise while exports will tend to fall, which will have a negative impact on your balance of trade position on your current account. And obviously, when a past paper comes on the circular flow asking about the macroeconomic impacts, so definitely you will end up making the ADAS diagrams and showing the impact on real GDP and inflation, right? And so guys, when we talk about equilibrium in the circular flow, I told you guys that it is when your injections, your planned injections equal your planned withdrawals, or let's say injections equal withdrawals, right? And I told you that when your injections do not equal withdrawals, like I gave you the example right now, that maybe injections are more than withdrawals, and it could be because of a rise in investment. Let's say there's autonomous investment spending in the economy is rising, and a rise in that autonomous investment spending boosts AD, and that causes your injections to be more than withdrawals. So now we need to understand what will happen. So I told you what will happen as in the macroeconomic impact, but if your injections are more than your withdrawals, if your injections are more than your withdrawals, then this means that there is a state of disequilibrium in the economy. Disequilibrium. You need to understand that, as A-level students, disequilibrium, you have to understand what the word disequilibrium means. Disequilibrium does not only, although it means that two things are not equal, but economies automatically, the macroeconomy will automatically achieve equilibrium. Because when something is in a disequilibrium, it means that there's tendency to improve, so tendency to change. So although you have a disequilibrium right now, but then there is still a tendency exists that ultimately things will reach equilibrium. So when injections do not equal withdrawal, a state of disequilibrium exists. But what this will do is that this is going to instill or set in, it is going to basically set in train a process. It will basically set in train a process to bring the economy back to a state of equilibrium automatically, where ultimately your injections will equal withdrawal again. But this time you will have a new level of equilibrium, a higher level of equilibrium than before, because your investment expenditures had gone up and your AD had gone up. And to sort of illustrate this, what we can say is that let's consider a situation, guys, and I want you to pay very close attention to what I'm going to say, because this is important. And let's say that your injections exceed withdrawals, maybe because there has been a rise in investment spending in the economy, and so let's say your investments are going up. Or it could also be maybe due to a rise in your export expenditures, or maybe let's say the government spending is going up. Let's say the government spends up, $100 billion more on the economy, let's say, or it could be multiple reasons. But let's say investment goes up, and investment goes up because maybe there's a rise in business confidence. And so if the investor and business confidence across the economy goes up, and firms are more optimistic about the future state of the economy, so investment will rise, and so it means that injections will go up. And if your injection increases, there's a rise in autonomous investment expenditures. Or maybe it could also be that perhaps instead of investment spending going up and injections going up, maybe withdrawals go down or leakages go down. So either injections go up or withdrawals go down. It could be both ways, right? It will have the same impact if either injections go up or if withdrawals go down. So maybe there has been a tax cut, and because of that tax cut, less taxes. So because of that tax cut, what will happen is, because taxes are a leakage from the circular flow, so the tax cut will result in less withdrawals, so the withdrawals will fall. And as I've already told you guys before as well, that the excess of injections, as your injections go up, so suddenly there is an disequilibrium state. And this disequilibrium state is representing that they both are not equal. Injection and withdrawal is not equal. And the fact that injections are more than withdrawal, it means that you have excess injections or excess of injections over withdrawals. And this will result in a rise in your national income, right? Your real GDP national income will go up. But the thing is that you see, the point is, okay, fine, your national income would start increasing until it would keep on increasing. This would keep on increasing. This would keep on increasing until equilibrium is reached, right? And this equilibrium will be a higher level of equilibrium, as compared to the previous equilibrium. So what we're saying is that this excess of injections over withdrawals will lead to a rise in national income. And the thing is that if you're saying that until it reaches equilibrium, so equilibrium means that injections basically have to be equal to withdrawal again. And so if injections are going up, so how can they equal withdrawal? They will equal withdrawal because automatically what will happen is that when injections are going up, your withdrawal will start rising as well. Because when national income is going to go up, your national income is going to go up, what will happen is that as your national income would go up, so your withdrawal would also start going up, right? Because you see, the thing is that as national income goes up and people's income rises, so households would not only spend more on domestic goods, but they would, so it's not that all the income that households are earning, they will spend back on domestic goods. Obviously, they are going to save some of the income as well. They will pay more income since their income is going up, so they will pay more in taxes as well. And since their living standards are going up, so they will, and their incomes are going up, so they will probably import more as well. So they will buy more imports, they will save more, and they will save more in taxes. So your withdrawals would basically increase across the withdrawal line, right? Now, what is the withdrawal line? I'll see if I can sort of explain that in some another video where I can show the equilibrium through the injections and withdrawals diagram. If you want that, if you want me to make that video on the injection withdrawal diagrams and show that, I can do it in part 3 of the video. You can mention in the comments for that, but only if you want me to make that video, I can definitely. Anyways, so coming back, what we're saying is that your withdrawals would also go up simultaneously, and in other words, your withdrawals will rise, and this process will continue. That is, withdrawals would keep on rising. This will continue until they have risen to equal your injections, right? And hence your injections will equal withdrawal again. And at that point, when this happens, your national income will stop rising. Stop rising means, again, no further tendency to change rises. So the initial disequilibrium that we had will again convert into equilibrium. So national income will stop rising, and so will withdrawals also stop rising. And now your equilibrium has been reached. Your economy is back in equilibrium now. So your circular flow is in equilibrium, your macroeconomy is in equilibrium, your GDP is in equilibrium, your real GDP and national income both are in equilibrium. Right, guys? So I think that's about it. I have sort of covered the circular flow for both open and closed economy. If you guys want me to also show you the diagrams for injections and withdrawals, I can do that as well. And I think that's enough for this video. I think the video is getting a bit longer, so I'll see you all in the next video. Until then, take care.